I would like to introduce to you a man, when I asked him, Jack, can you take all of your knowledge, all of your research that you've done in the annuity business, can you take it and turn it around into this life white paper and seminar series? He did. We liked it so much, we bought it. Ladies and gentlemen, it's with great pleasure I turn this over to my friend, a true professional, Dr. Jack Marrion.
Thank you, Ray. We'll get this thing started. The topic is the irrational life insurance buyer, which is a little strong. What we're really talking about is why life insurance buyers don't always make completely rational decisions. We like to think that we do make rational decisions. We like to think that we take in that data and we process the data and it rattles around in our brains, and then what comes out is the best possible decision we can make knowing what we do. But that's not always true, and we're going to get into those elements. There are certain things, though, that you can't forget about the rational brain. There are rational reasons to buy life insurance, and there are sales that are missed because we don't bring up the rational reasons. So the first part of this is to talk about who buys life insurance, and more importantly, who doesn't buy life insurance and why. Every couple of years, LIMRA does a survey asking exactly those questions. And they produce studies, and these studies are wonderful studies. The only problem I have is they use a lot of statistics. And they use statistics like 67% of the 24% of the, or 87% of the 16% of the quartile. I mean, a lot of that stuff. And it can get kind of confusing what they're really talking about on the bottom line. So to make my life simpler, what I did is I just imagined that the entire country had 20 people in it, and then I applied the statistics to see how many of those 20 people were affected. So we're going to assume right now that the United States has 20 people in it. If you think of it that way, 9 of these 20 people own individual life insurance policies. These are not group, these are not through work, these are individual policies. Is that good or bad? I don't know. 30 years ago, 11 out of 20 owned them. Now it's still 9 out of 20. It's not bad. What about the people that don't own life insurance? Well, 6 say they don't need it. 6 say they can't afford it. But of those 6, 3 said they'd buy it if they could find a way to afford it. And 3 says they don't own it because nobody's ever talked to them. They've never met a real live insurance agent. Now, I realize that 6 plus 6 plus 3 plus 9 is more than 20. That's because people gave more than one answer. But the people that didn't buy kind of illustrates what we can say to get more people to buy life insurance. You have 6 people that say they don't need it, but that could be because they're framing the life insurance answer as a very narrow one. They may just think of life insurance as something you do to produce a pot of cash to support the kids when you die. But they may not have thought about using life insurance to pay for estate taxes or possibly to create future income by fully funding a cash value policy. Or something I'm discovering through other research I'm doing on boomers. Boomers have a strong need to create, try that again. Boomers are very interested in charitable giving, more so than many other generations. And a lot of them feel the need to provide a legacy to continue that charitable giving. How many of them have been talked to about life insurance, to use life insurance to provide a bigger legacy? So if we can talk to these people that say they don't need insurance and show them other needs that insurance fulfills, 1 to 6 people may buy insurance. You also have 3 people that say they'd buy it if they could afford it. Well, maybe we could show them how to afford insurance. Maybe they don't realize how inexpensive it is. Maybe we can help them by readjusting assets so it frees up some money to buy the insurance. I'll give an example of that a little later on. And then you have 3 people that don't own insurance because no one has ever asked them to buy. Nobody's ever used that time-honored insurance prospecting line, you don't want to buy any life insurance today, do you? So what we have to do is ask them to buy. But if we could just pick up one of the people that nobody's ever talked to, one of the people that can't afford it, and one of these 6 that say they don't need it by showing them a need, we'd increase the number of life insurance owners in this country by 1/3. So there are strong, rational reasons for people to buy life insurance, and those need to be presented. There's also emotional reasons, and one of the things I give credit to the insurance industry is they early on realized there was an emotional component to financial decisions, and they operated on that basis. And that's been very strong and very powerful for the industry. It works so well, the industry tends to get away from it and only focus on the rational side. And to pick on one example, MetLife has been running some ads on life insurance. And one of the ads has Lucy sitting in her little psychiatrist box with the 5-cent psychiatrist label on the front. And she's talking to the MetLife spokesperson saying that their life insurance should be 5 cents too, because that's what she charges. And the MetLife person is saying, no, Lucy, our insurance is affordable, but it costs more than 5 cents. Now, I understand why they're running the ad, because it appeals to that, could I afford this part of the rational sale? But I think it'd be much more effective if they applied an emotional approach. Instead of using Lucy, they had Charlie Brown dead in the ground with Snoopy sitting on his grave crying. Then get to the decision-making process. And what these biases do is they taint or color the data before it even gets to the brain. And what this is about, and the future webinars are about, is stripping away the biases so the client can appreciate what you're really talking about, so they can get to the heart of the data and make a logical and concise decision as to why they do or do not need insurance. So that's what this is about. And what it comes down to really is broadening the mind. For example, if we look at the whole world and make a decision looking at the whole world, and we're giving choices like these, we might make some interesting decisions. I mean, if we went into the grocery store tomorrow and a can of coffee cost $40, we might walk out without buying the coffee. If this weekend we went down to the 7-Eleven to buy a 12-pack of beer and the beer was $80, we might switch to a different beverage. And closer to home, if you put a sign out in front of your office saying lottery tickets $1,000, which are expensive lottery tickets, but the tagline is you guarantee to give the player's family $100,000 as long as they keep playing the lottery year after year, you'd have people lined up around the block. That's what this broad framing does. But we tend to look at things much narrower, and it results in different decisions. You know, we wouldn't pay $40 for a can of coffee, but we'll go to Starbucks and spend $4 for a coffee latte or a frappuccino, which works out to a lot more than $40 a can. We'll pay $7 for a beer at a ballpark without blinking. And the same client that would buy lottery tickets year after year after year won't give you a $1,000 premium to buy a cash value life insurance policy that is guaranteed to pay off $100,000 as long as he keeps playing. And if he dies before 21/12, it's a guaranteed winning ticket because he'll have put in less than he paid. Excuse me, get back less than he paid. So what often screws up decisions is the way we frame the decision, the way we color the decision. And what we're trying to do is, again, broaden the frame so the client has all the facts. And the problem is the decision-making process works against us. 30 years ago, a couple of guys named Tversky and Kahneman started going around asking people 2 questions, and each question had 2 parts. They'd ask the people first, would you prefer to have $250 in hand, I'll just hand you the cash, or a 25% chance to get $1,000 with a 75% chance you walk away empty-handed? Choose A or B. Now, simultaneously, would you prefer to write me a check for $750 or have a 75% chance you might lose $1,000 with a 25% chance you'd lose nothing? These were the decisions they presented them with. Now, you'd think if the person was a gambler, they'd choose B and D. They'd risk it getting nothing because there's a chance of getting $1,000. And since they're a gambler, they'd risk losing the $1,000 because they might not lose anything. If the people were conservative, risk-averse, savers, however you want to call them, they'd pick A and C, the sure thing of the $250 or the loss of $750, which at least is better than the possible loss of $1,000. And rational economic theory, traditional economic theory, says exactly that. People will pick A and C, or people will pick B and D. However, what Tversky and Kahneman found out was 7 out of 8 people picked A and D. They picked the sure thing when they had a gain. They were willing to gamble when they had a loss. And this is completely contrary to the way economic theory had been done up to that time. And it created a whole new branch of economic theory called behavioral economics. And you see this type of thing all the time in the investment world. Somebody will put $100 into a stock, the stock will go up to $150, and they'll sell the stock because you could never go broke taking a profit. By the same token, if that $100 stock dropped to $50, they're less inclined to sell the stock. They may hang around for a while just in case it goes back up. In fact, they may even buy more. They may dollar cost average. They'll risk the stock going lower if they're in a loss situation. So most people, their inclination is to be risk averse or go for the sure thing on gains, and to be risk seeking, gamble a little bit when they're in a losing situation. That's the way most people make decisions. This is the decision we ask people to make when they're buying life insurance. And we're going to assume that the life insurance policy has a $10,000 death benefit and a $200 premium just because. What that says to the customer is, Mr. or Mrs. Customer, you can either win $200, which means don't buy the life insurance, put the money back in your pocket, spend it on something else, or you can have a very slim chance at getting $10,000 with a real big chance you'll get nothing. And the other decision is you can pay me the $200 and buy the life insurance with a very strong probability that it won't be needed in the next year in the short term because you won't die in the next year or become uninsurable. The person in a life insurance situation wants to choose A and D. We force them to choose B and C. That is the reason why life insurance is such a tough sale. What I've been talking about is something called prospect theory. And what this essentially is the insurance corollary to prospect theory. It explains why people do not buy life insurance, why they're less inclined to buy life insurance. Because 7 out of 8 people are not risk-seeking when they have a gain and going for sure things when they have a loss. So this runs contrary to the way most people want to make a decision because of the way this decision is framed. How do you make a life insurance sale? You change the framing. And I've got just 3 examples here. There's a lot of them, but I'm going to go through 3. One way you can do it is you change the loss. $200 is $200, which maybe seem like a lot of money. We also said a cup of coffee was $4, so 200 divided by 4, essentially that's the equivalent of $50 of coffee. Excuse me, 50 cups of coffee. So if we present it as coffee and not money, what we're saying to the customer is, would you rather have a cup of coffee a week or a chance to give your heirs $10,000? Or, much more strongly, which would you rather your widow and children get when you die, a gift card for 50 cups of coffee or a check for $10,000? So one way we can change the framing is to change the perception of what's being spent, the cost of the premium. Here I use coffee, but you've seen examples of this in a lot of life insurance ads over the years. They'll say things like, for pennies a day, for the cost of a newspaper, for the cost of a cup of coffee, all that happy stuff. And the reason is it works. So one thing you can do to improve the odds of a sale if you run into resistance is change what they're spending the dollar on into something that is less attractive. Another thing you can do is change the perception of the risk. They don't think they're going to die the next year. So you're sitting down with your 39-year-old prospect and that they may need the life insurance. And by the way, those birth dates I just pulled out are listed at a website called deadatyourage.com. It's an interesting site, if nothing else, and it can be useful for this industry. But again, change the perception of risk of the payoff. And another thing you can do is change the frame, broaden the frame. They're concerned about the cost. They don't want to pay the $200, but you notice they have $50,000 sitting in a CD earning 0.5 point, which is only $250 worth of interest. You can offer them an annuity today. They'll pay 1%, giving them $500 worth of interest. Even after paying $200 for the life insurance, the client still has $300 with your choice. So now the framing is, would you rather keep your money in the CD where you get $250, or would you rather get $300 plus a chance at 10 grand? Or on the loss side, would you rather lose $50 in the CD automatically, or make $50 automatically with a chance to win $10,000? By changing the framing, we make the insurance more attractive. So these are just 3 examples of how you change the insurance frame to increase the probability of the purchase. Change the loss frame, change the perception of risks, change the reward. Changing the framing can also come into play during the underwriting process. Limmer found out that 1/4 of non-buyers say the reason they don't buy is it's a hassle. They don't want to buy life insurance, it's too much of a hassle. And to some extent that's probably true. You've got a whole generation of people that are used to buying things by pointing with their mouse, clicking, and they're done. The stuff gets shipped. Normally when you buy life insurance, it ain't that simple. You're going to have to fill out some questions, give them some personal information, maybe, God forbid, talk on the phone to a real live person, or at worst get a paramed. So it is more of a hassle to buy the life insurance. That's for the younger people. For the older people, there are some privacy issues. You may not want to share with a stranger over the phone your bodily functions, but that you'll share with your doctor. But I think there's something that people usually don't talk about that's also a factor for older folks, and that's that they don't want to confirm what they suspect. I mean, it's one thing to think you might have heart disease. It's another thing to find out that you do. And there may be a fear of underwriting because it might disclose what they don't want to know. But in both cases, what people are saying to you is it's just not worth it. You need to change underwriting into something that is worth it, and you present it as a discount. You present it as a coupon for going through the hassle. And the way you do this is first you admit that it's a hassle. Nobody jumps up in the morning and says, hey, I want to do a paramed. So admit it is a hassle. And you tell them that they can have the hassle-free experience. You can sell them guaranteed issue life with no underwriting questions at all. And that's true. You can get them guaranteed issue life, absolutely hassle-free, and that tends to be rather expensive. So you tell them that you can give them a discount if they'll share personal information. And they're used to this concept because they're putting in personal information on these retail sites, and by entering more personal information, they're getting things like discount cards and coupons and promotions. Well, this is the same type of thing. The more personal information you furnish us, the better the chance of getting a bigger discount. So what you're showing them is, yes, it is a hassle, but essentially underwriting works as a coupon, a discount off full price, and you are a smart shopper. Smart shoppers use coupons. So if you're running into resistance, talk to the client about underwriting being a coupon they can use. And these are the main things I wanted to hit today. There's a lot of other areas where framing comes into play. You can focus on different rewards by broadening the framing when you're comparing investments, banks, and single premium life. One example I have here is a single pay life we looked at, paid $193,000. For the bank to equal that type of payout in 10 years would take a 7.8% annual yield after tax. So there are a lot of ways you can look at insurance from a behavioral point of view, and it increases the propensity for the person to buy insurance. In the future seminars, we'll be talking about more of the framing and also things like objection preemption, which is making sure that the objection never comes up. And Ray, that's all I had for today.
Well, Jack, I really appreciate your time today, and I've seen this before. We talked about it, but I continue to learn new things as I listen to you and watch it. The presentation is nice and simple, and the framing is so important. So yeah, this is, we're thankful that everyone